To the extent that the bond market has started the pivot, which is what I believe is happening, not the Fed, the bond market, which owns the Fed. If you look at the way long duration yields have been dropping on the Treasury side of things, that for a moment in time would suggest that you probably hit peak inflation, that mortgage rates probably drop, that lumber and housing starts to maybe be down less after all the cataclysmic stuff that people have been saying after I said it on Kitco back in like February, March of last year. There's always these cycles that come out in markets. I suspect if last year was the year of the duration crisis, of the correlation crisis, this year becomes the year where things normalize, not in terms of trend, but in terms of intermarket movement, meaning that you start to see the right behaviors kick back in again. And from that, there's a lot of implications for asset allocators, traders, and anybody in general that's interested in markets. There's a general rule of thumb, right? You want to buy dislocations and sell normality, right? I mean, last year was a dislocation. I keep going back to that point that never in history did long duration treasuries lose more money than stocks in a top 20 drawdown for stocks. All the narratives that keep getting thrown around this are nonsense. People say long duration sold off hard because the Fed hiked rates. Okay, except that historically the Fed hiked rates, long duration treasury yields still acted as a safe haven when you had high volatility in equities. The argument that this is because of rates being too low, okay, or because of quantitative tightening, okay, well then explain to me why, as the Fed is selling bonds are getting bid up now, right? So there's a lot of narratives I think that got countered. Look, I think there's. I always go back on Twitter. I say, unpopular opinion can be both bullish and bearish at the same time, right? Because it's always a function of time frame. So I think the way the year has played out and the way certain sectors are now behaving to start 2023 is favors, conditions that would be conducive for risk-on sentiment for equities. You look at consumer discretionary stocks; they're bouncing relative to staples. You look at small caps starting to lead. You see this kind of continuation of the things which got bombed out on the cyclical side, starting to outperform, while the defensive sectors, staples, utilities, healthcare, those out of the gate are pretty weak. Now, should that continue, that would be exactly what you want to see in an environment that favors the bulls. But people forget there are lags when it comes to interest rates, the economy, and markets. We went through the fastest rate hike cycle in history. It was a devastating period for bonds. It was not really a devastating period for stocks in the sense that you did not have a VIX spike. You did not have a credit blowout. I think that's still coming at some point this year. So if you think about time frames, bear markets make fools of bulls and bears. You're probably going to have a continuation higher, given the way the year played out. But at some point, there's going to be a tail event, I suspect. And if that's the case, that means you get back to that historical flight to safety behavior in treasuries. First of all, in general, when you're below a 200-day moving average, that tends to occur when you're in a recession. If you're an active trader, I would argue that the conditions are there for a continuation of the move higher. That doesn't mean you can't have a big decline. I mean, I was very bullish October 2nd. I was then very bearish on December 2nd. Of course, December, no crash, but still was a nasty period. All the signals that I use that have historically been proven to be leading indicators suggest that in the near term now we're back in a sunnier environment to start to speed up in. But if you're going to be a long-term investor, you got to be mindful of still a credit event that might be out there. But I'm going to argue even more importantly than that, the last decade has been dominated by large caps, by U.S. Why is that? Well, because of QE3 and zero interest rate policy, both of which are now gone. You don't have quantitative easing, you don't have zero interest rates. All the stuff that made U.S. stocks pull away from international is no longer a tailwind for momentum players. So if you're really going to be forced to buy into stocks, sometimes the best thing to do is to go into the biggest laggard, which really is what emerging markets are. If you were to look at the VIX index on the S&P, okay, volatility, and compare it against credit spreads, you'll see a one-for-one relationship, meaning when you have a VIX spike, when you have a big decline in stocks, credit spreads will blow out. Junk debt becomes junkier because in the bond market, then the perception of high volatility in equities means default risk is increasing internally in the bond market. That's what the Fed cares about, right? They care about the impact on the real economy as far as credit spread movement. Now, you did not have credit spreads blow out. What's remarkable about 2022, despite the carnage in the bond market, is that it was largely duration driven. It was largely not a situation where the market is reassessing the potential that a debt issuance goes bankrupt. It was just a shift in the entire curve. If you believe that there's still a VIX spike, you must believe that there's a credit spread event coming. And if that's the case, that's probably where the Fed starts to then re-liquefy, assuming it gets out of control. I would argue that the Fed actually wants to see spreads widen somewhat. They want to see some degree of defaults in the economy, because the fastest way to kill off demand inflation is to kill off companies. The thing is, like, when you're already highly levered, every single one of these types of events, when they occur, tends to be much more amplified because there's more leverage against it that you've got to reliquify, to protect. So who knows? It's one of those things where I think the setup is there at some point. Again, I think this year. I've also seen some studies, and I need to do, admittedly, some more work on this myself, but if you look at a lot of the small business loans that happen, around the time of COVID, they apparently mature in 2024. So, well, if that's the case, the market would start to sense that earlier, right, in 2023. So it could be one of those things where it's the rollover of some of these COVID stimulus, which ends up being the real spark for a lot of this. So I launched my mutual fund, ATAX, September 12th in 2012, a day before quantitative easing 3 began. And part of the rules-based approach with my mutual fund is that when it goes risk on, it tries to play relative momentum in emerging markets. The idea there is that up until 2012, there was co-movement. When the U.S. would run up 1%, emerging markets would be up like 2%. It was just a levered play on U.S. stocks. So here comes QE3. And if you notice on the distribution chart, basically what it shows is that in the quantitative easing 3 period of 2012 until the first hike that happened last year, you see more extremes on the downside of emerging markets, whereas U.S. stocks didn't have a fatter tail on the left. In other words, U.S. stocks were less likely to have major declines, while emerging markets were more likely to have major declines. The thing is, before quantitative easing 3, the U.S. and emerging markets were both likely to have major declines, right, on terms of losses, daily, weekly, monthly. So the effect of quantitative easing 3 is that it destroyed the tail for U.S. stocks. It made the U.S. the most attractive place to be because it suppressed all volatility, suppressed all risk, while emerging markets still had the same dynamic they had before quantitative easing 3. It's interesting now, and that also is what broke the correlation, right? If you look at that clearly, there's another chart I had that shows that if you look at the correlation of emerging markets to the U.S., it was very tight up until quantitative easing 3, structural break, and then suddenly the U.S. pulls away from emerging markets and everything else. Now, as the Fed has been hiking rates, guess what? The correlations are reasserting. Guess what? The tail risks are starting to look more similar between the U.S. and emerging markets. This is a really, really important dynamic from a cycle perspective, because if I'm right in my theory that quantitative easing 3 was a real structural break in the relationship of U.S. stocks to emerging markets in particular, and now you reassert that correlation, then if you really are going to be an investor, maybe the place to be is outside of the U.S. That the playbook which worked because of the Fed's suppression of volatility needs to be rethought from where to get returns from. So as you know, there's a lot of people that don't want to touch China. All right, a lot of financial advisors I talk to don't want to touch China, which maybe why you actually want to consider China, right? Just from a contrarian perspective, because no matter what anybody thinks about China and the risk on the geopolitical front of what they could do, the reality is there's a price for everything. All right, so I suspect if you really want to, get creative, China is probably the place to be. Now, having said that, there's a lot of other emerging markets you can argue for, like India and a lot of the Latin America type of ETFs that are out there. But it's a broader argument, right? It's like we know that QE and zero interest rate policy benefited large cap U.S. tech. Okay, everyone says that dynamic is done. Okay, well, if you look at a lot of the emerging market ETFs, a lot of them don't have tech. A lot of them are actually value sectors. Anybody that argues that value is going to outperform growth, they're basically making an argument for emerging markets. Anybody that's going to argue that commodities are going to outperform stocks, they're making an argument for emerging markets. Anybody that's going to argue that energy would outperform tech is making an argument for emerging markets. So it's a broad allocation play. What specific countries, that's up to the listener.